Hi, everyone, and welcome to this episode of Money Moves. I do this video every 2 weeks, and I talk about the most interesting news in the markets today. And of course, everyone is talking about inflation. We see bond yields rising and commodity prices rising as well. And the market is starting to dip a little bit based on instability in interest rates, as well as just general fear and uncertainty. Then I will go over all of my investing accounts, starting with worthy bonds, talking about Fundrise, M1 Finance, my retirement account, as well as my options portfolio with Robinhood and Tastyworks. Then I'll talk about my biweekly tracker. Then, of course, there will be some jelly at the end, which is something I enjoyed outside of the markets. If you have big dreams like owning this 6-bed, 6-bath mansion outside of Austin, Texas, or if you're just getting started on your financial journey, definitely like and subscribe. I do these videos every 2 weeks, as well as 1 or 2 videos during the week. And the weeks that I'm not doing these videos, I do full options portfolio overviews, which is definitely worth your time if you're an options trader. Too bad about those nasty yellow couches though. Welcome to the Portfolio Bulletin. Let's get started. So inflation is coming, but what can you do about it? To be fair, Jay Powell is saying that inflation is going to come, but if it's higher than the 2% that they tend to target, they are willing to let that go for a little bit longer with the purpose of putting more money into the economy in order to stimulate it and ensure that we have a healthy recovery. Currently, inflation based on the government preferred method, which is Consumer Price Index, only rose 1.4% over the last year from January to January, which is below their goal of 2%. And over the past 10 years, it's been a tepid 1.7%. So we haven't seen inflation of any real effect based on this metric for quite a while. But as I'm about to show you, we're seeing it in certain commodities. Specifically with food prices, we're seeing that everything is going up to higher than it was in January of 2018, which again should be expected because prices do grow over time. And we saw a small deflationary period from 2018 to 2020, except for oils. And these are things like vegetable oils, which have been a little bit choppy. And as you can see, since May of last year all the way to January of this year, they've gone up pretty substantially. So in the short term, we're seeing some pretty dramatic price increases, specifically in food. This may not be an issue because if you take a line from January of 2018 to January of 2020, the inflation rate is still not bad. And what we saw from January 18 to January 20 was a flat line, which is not what you want to see, as their goal is to inflate the currency very slowly. And this is necessary in a debt-based economy, which is what we have right now, since we moved off of the gold standard. Another place we're seeing pretty dramatic price increases is shipping costs. For quite a while, it's been around $1,500 to ship a 40-foot container. And recently, that price has gone up to around $4,500. Personally, I think this is due to a resurgence of the economy, and people are wanting to ship things at a dramatic rate. And it makes sense that these prices would go up as the economy starts to increase in its productivity. But these shipping costs are going to affect everything across the market, and it could be one of the indicators for what we're seeing in food. It seems like this would be a short-term trend as we get kind of a resurgence, potentially a taper here, and then a dip back down to normal rates. And that normal rate may be higher than what we've been seeing back here, as this may have been a depressed rate going back to March of 19. And as I was recording this, the House passed their $1.9 trillion COVID relief bill, which in perspective is around 10% of GDP. And then you have to consider the $900 billion that they passed in December. And then we go back to the CARES Act, which was another $2 trillion. So at this point, we've spent over a quarter of GDP, which is over 100% of the federal budget, on top of the federal budget that we spend every year, which is around another $4 trillion just by itself. Even the New York Times is talking about inflation, and this title's a little weird, but there are some parts of this article that are worth talking about. As I mentioned before, prices actually decreased from January 18 to May of 20, so we saw a small deflation of prices because the velocity of money had slowed down, and as people stop spending money, prices of things tend to go down because you are decreasing demand while keeping supply stable. So what we're seeing is a high year-over-year rise from May of 20 to probably May of 21, which will show a higher than average increase of inflation. But if you average that out over the long term, it'll be closer to that 1.5% to 2% that we've been seeing consistently because we had that deflationary dip. Now, this does not talk about the increase in general prices that we're seeing as natural gas services increase, especially with that cold front that we saw. Airline prices are going back to normal levels. And they even mention women's dresses here because it's one of the fastest growing sectors, up 17.9%. They also mention the fact that we might see retailers starting to pull back on their sales as they start to see higher demand and they want to maximize revenue and profit during this pent-up demand period, which seems like a reasonable expectation. They also mention that the US savings rate is higher than it's been in a very long time, and this reflects the pullback in spending. So what I'm hoping here is that we see Americans maintain their high savings rate, and that will give us more financial health as a country, and that we won't see all of this money get directly injected into the economy in a short period of time, which will reduce the potential for inflation. And then they go on to mention all of the spending that we've done, 900 billion, 1.9 trillion, as well as the 2 trillion from before. And what this means to me is that there is a potential that inflation could stay somewhat stable. And I get nervous saying that there's no chance for deflation, but it seems very, very unlikely at this point that we will see any kind of deflation or even relatively tame inflation. The statistics point to the fact that we will see inflation. The question is how much and how fast will that inflation come? And because the probability for deflation or even low inflation seems unlikely, people are starting to sell their bonds, especially bonds that are yielding very low rates, which is why we're seeing the federal 10-year bond yield go up. And here you can see the chart. So we're up to 1.4%, which is the highest it's been in quite a long time. You can see all through April and September, we were sitting right around 0.5% or 0.6%. And since September, we've had a meteoric rise compared to what we normally see in bond yields, meaning that these bonds are selling off at a rapid rate because people are projecting the fact that there will be some inflation, and we expect it to be higher than any rates we've seen on the 10-year yield in quite a while. And even at 1.4%, I don't think people are going to be wanting to hold this asset for 10 years, as there should be higher than 2% inflation during that period, which means you will effectively lose money on this because you're only getting 1.4% back. So what this really means is if you own these bonds, you need to find somewhere else to put this money because there's going to be inflation. The question is how much, and it will likely be higher than this 2%, meaning that you're effectively losing money by holding these bonds. Plus, if we go back historically, the 10-year yield is generally above 1.5% and sometimes goes all the way up to 3.2% here in November of 2018. So it seems likely that this will go at least to this 2% level, maybe even 2.25%. Meaning that people are continuing to sell these bonds and move over to different assets. And what this means for the government is that their money will be more and more expensive, and there's a potential for short-term yields to go negative as people sell out of these long-term yields and buy shorter-term yield while they're waiting to find new investments to hold their money. And if this happens, it might force the central bank to raise their rates, even on short-term treasuries, because they're seeing the economy heat up faster than expected. Even though they continue to try to calm the public and say that they will not raise these rates. Basically, the public is saying, we don't believe you, there will be inflation, and then you will have to raise rates, at least a little bit in the short term, which will make the cheap money more difficult for companies, which is why we're seeing volatility in the markets right now. I also want to show a clip from Lawrence Summers, a former US Treasury Secretary, and his thoughts around inflation.
But I do think that we need very much to have a sense of two-sided risk. And right now, I think the risks of inflation, of financial bubbles, of economic overheating, of excessive euphoria in markets, I think those risks are much greater than the risks of deflation, of insufficient aggregate demand. That could change, but right now, I think we are still fighting the last war in the rhetoric of policymakers. We're still fighting the war against a COVID-caused shortage of demand when the greater threat is a war against COVID, classic wartime inflation pressure. And that's, I think, the disconnect between reality and a certain amount of the policy thinking that's underway.
Aside from the fact that he opens his mouth quite a lot when he talks, he's echoing the same things that I mentioned before. The risk of bubbles and the risk of inflation is significantly higher in probability than versus deflation and lack of supply in the economy. And because of this, people are starting to make that trade to where they're selling bonds and looking to find other assets, possibly looking for hard assets in order to preserve their buying power in this time of potential inflation upcoming. So the way to hedge against this inflationary risk is to buy hard assets, things like gold, or really any kind of hard asset. Things like commodities, grains, precious metals, oil, or any kind of futures will allow you to hedge against this potential price increase. Another very strong candidate is real estate investment trusts, because real estate is a hard asset and tends to go up with inflation also. They say the S&P 500, which will potentially inflate with the currency, but in my opinion, there's more risk here than buying commodities. Again, they mention real estate income. Then they mention the bond index, which isn't a terrible choice as long as it's yielding a decent return, but staying away from government bonds. Then they talk about investing in leveraged loans, not suggested for the average investor, and something I'm not looking at either. And then they talk about TIPS, or Treasury inflation protected securities. And these are adjusted based on inflationary rates and are put out at various maturities. You can either buy them directly from the government or use the iShares TIPS bond ETF, ticker symbol TIP. But if we see dramatic inflation, these TIPS will probably not keep up. And again, it's not something that I'm looking at personally. Moving on to my investments with worthy bonds, you can see I've sold quite a lot of bonds here recently, a little bit over $2,500 worth. And I plan to continue to sell this interest and maintain this level at around $8,000 for now. And I'm moving this money over into my IRA with Tastyworks primarily, and there's potential I might move it into M1 Finance and start buying some equities as the market has dipped here a little bit. And I think this is a long-term buying opportunity. And I think this 5% yield may keep up with inflation, but I think there's more risk that inflation might go higher than expected, at least in short stints. Again, if you like this platform or any of the platforms that I'm going to talk about, there are links in the description that get you free stuff when you sign up with them. And it's no cost to you to use those links if you plan on signing up with any of these platforms. Moving on to Groundfloor. These are short-term bonds investing in individual home renovations or builds. And I continue to increase my investments here pretty dramatically, up a little over $500 invested, as I continue to invest $30 in every single loan, and I've gotten this up to 72 loans, which is pretty well diversified. I think this protects me against any kind of defaults or losses, and I will continue to invest all of my money coming out of Lending Club into this platform. If I start getting too much money out of Lending Club and the notes are not available here, I might buy some equities with them, but this is the primary location for that money. And of course, all of the money in here already, I will continue to reinvest as some of these notes mature. And you can see here, I'm currently fully invested, no money on the side, as all of my money is invested in notes. Looking at my current holdings, you can see the majority of my notes are in these C-note loans, 55%, yielding just under 10%. I have a few notes in this A category at 6.4%, and I think I might start pulling back on these. There's not a ton of them that become available, but 6.4% is not a great return, especially when you adjust for inflation. And the goal here is to get higher than that 5%, especially since these are illiquid for their term versus worthy bonds, which is liquid. But like I said, there's not a ton of these, and I don't know how valuable it will be to pull back on them. So for now, I'll just continue to invest in every single note and continue to diversify this portfolio. Moving on to Fundrise. If you're interested in real estate and buying into REITs, especially privately traded REITs, this is the platform that I think is best. And they have made some adjustments to their platform. You can see they are now dividing their projects based on what category they fall into instead of what REIT. You can see they have fixed income, core plus projects, value added projects, which is equity, and then opportunistic. You can see the majority of my money is in the value added category. I have a lot of projects in opportunistic, but it doesn't make up a large percentage of my portfolio. And then fixed income and core plus are pretty small, for a total of 189 projects, which is pretty diverse, which is what I want to see as an investor, as diversity is generally a protection against ignorance, and I don't know a ton about investing in real estate, which is obviously why I pay them to do it for me. Not a huge amount. You can see my advisory fees here, but that is basically what I'm paying them for, is to find these projects and invest for me. Another big thing worth mentioning here is they have announced they will be doing another internal public offering to investors. They say that their minimum investment is $19.08, which is 2 shares at $9.54. To be eligible, you just have to be an investor with Fundrise, and then your maximum is half of your portfolio at a cost-adjusted basis. You can see I invested $4,200 the last time they did an IPO, and my current 50% limit is just over $12,000 based on my total investment cost basis, allowing me to invest $7,700. I don't plan to max this out, but I do plan to buy some more shares with Fundrise as I think they have a bright future as a company as well as an investing platform. And when you look at share value, they continue to increase. Of course, they're setting these values, but they're based on current equity invested with the platform. So in December of 2020, they had $1.35 billion invested with them, which continues to grow exponentially. In 2014, they just had a few $100,000. And 6 years later, they're over $1.25 billion with over 148,000 investors. This platform seems to be growing quite rapidly, and they do talk about the potential to go public in a couple of years. So this is not a short-term investment, as I would expect at least a 5-year term before they go all the way public, but that would be the time you'd be able to sell these shares, and I expect the company to be worth quite a bit more in that time frame, especially based on its current growth profile. Even if you look at their price, they don't raise it dramatically. In January of 2017, they had it at $5. I bought here in January of 2020 at $8.87, and now they're saying the shares are worth $9.54. You can see it's been a while since they valued their shares. They only did it twice this year, which is unusual based on their previous profile of doing it every few months. Probably because it was more difficult for them to price them in during the Rona. But even during that period, they're saying the company is more valuable. And as I mentioned, I do plan to buy some more shares. I just haven't determined exactly how much yet. Moving on, I do want to talk about Yotta Bank real quick. I didn't mention it in the intro, but I want to mention my high yield savings here because I did withdraw a little bit of money from it. I'm going to keep it at this $3,000 level for the foreseeable future. And I want to mention here that I do have a Yotta Group. We are up to 3 members and 330 tickets. If you want to be a part of this group, all you have to do is be a Yotta member and then use this public invite code, the Portfolio Bulletin. And you can see I have all of my tickets in here, and then we have a few other people that have put all of their tickets in, and it'd be really cool if we could build this group up and we could all win a little money together. Moving on to M1 Finance and my Retire account. I haven't done much with this. It continues to build dividends and reinvest. The market was basically flat over the past month, down just 0.25% if you include my dividends here. Looking at the portfolio overall, finance is the outperformer in the past month. Tech is down, healthcare is down, utilities are down, and consumer is down. Real estate is in second place here, and somehow dividend ETFs are completely flat at 4 cents of growth. A little bit weird, but I have no adjustments to make here. If anything, I think I'll increase my real estate holding just to combat inflation, maybe raising this one up and decreasing healthcare as well as decreasing consumer. So I'll bring this up to around 16%. Moving on to my higher yield savings account, you can see it's down 0.75%. Again, pretty stable, which is what I want to see out of this portfolio. Over the past month, you can see VIG is down. Short-term government securities have been basically flat. I may start to sell some of these and reinvest this money into other things. Realty income was up over the past month. Bank balance sheet down 1%, midterm bonds continuing to go down, which is what you expect when you see inflationary risk. People are starting to sell these bonds because they're not going to keep up with inflation. And it may be time for me to sell some of them as well, as it doesn't seem this trend is going to stop anytime soon. And you can see here long-term corporate debt is doing extremely poor at down just over 4%. I also want to briefly mention here with M1, if you're using their borrow account or this line of credit that they give you against your stocks, this is an adjustable rate. Currently it's at 2% because it's based on the federal funds rate. But if the Fed is forced to increase their rates, there's potential that this could go up. So keep that in mind if you're using this line of credit and the Fed is forced to increase their rates due to an overheating economy and inflationary risk. This rate will also go up and you may not be able to use this money as cheaply as we have been over the past year. Moving on to my retirement account, I did make some adjustments that are not reflected here. I'm going to stop contributing to the 2050 fund as I want to manage these more directly. So my money will be broken up between the F, G, S, and C funds, and that adjustment will happen next month. And looking at exactly where that money is going to go, you can see the 2050 fund will go down to 0%, 10% into government bonds, 5% into the total bond ETF, 40% into the S&P 500, and 45% into the S fund, which is the total stock market index. Personally, I see a little bit more value in the total stock market index, or what they're calling the small cap index here, than the S&Ps, which I think are slightly overvalued right now. So S&Ps will stay basically the same at 39%, and the small cap index will go up quite a bit from 28% to 45%. Moving on to Robinhood, you can see we're still up over the past 3 months and up very small over the past month. A little bit choppy in here. You can see I'm down quite a bit since February 20th. I was up over 9%, around 9.5%, and I'm down to around 2% up over the past month. Not terrible returns, but if you look at the 3-month, I'm basically flat from January 10th and 11th to current pricing, which is okay. I'm not super concerned. It's better to be flat than down, which the overall market was down. Positions worth mentioning here, I do still have this GE position, which I plan to wheel for all of 2021. And then I still have a little bit of crypto in here. All of this is down right now, but I plan to buy more Bitcoin in here, as I think this is a pretty decent protection against inflation. PLTR continues to sell off, which is another stock I need to talk about. Otherwise, if you want a more in-depth overview of this portfolio, definitely check out my full portfolio overviews that I do every weekend that I'm not doing these Money Moves videos. Moving on to my Tastyworks portfolio, you can see I'm down quite a bit. Year to date, I'm still up almost $2,000, but I was up over $6,000 at one point, and all of that has come down in the past week. Part of that is because I made some mistakes trading, and part of that is just because the market is down overall. And I also plan to do a video updating my position on Beyond Meat. They did come out with earnings, and they've announced a lot of partnerships. It's something that I want to talk about. So definitely make sure you subscribe so you don't miss out on that. Also, another position worth mentioning here is gold. Gold continues to go down, but I see this as a more bullish position going forward, and I plan to roll this out in time as this is a hedge against inflation. This is kind of a derivative way to invest in commodities for less capital. Moving on to my biweekly tracker, you can see everything was down. Stocks were down, trading was down, even though I contributed to both of these during this period. Bonds are down because I did divest a lot of those worthy bonds to move it over into other investments. REITs continue to go up as I invest in them, and they are starting to grow here as they are a decent hedge against inflation, and we are seeing the potential reopening of the economy sometime in late April, maybe early May. Lending Club continuing to trickle down. It seems like it's accelerating a little bit. And then cash continuing to stay flat here because every single dollar is either paying a bill or getting reinvested. Overall, I'm down a little bit more than 2.5% across my portfolio, and this is just hard to get around when the entire market goes down. My investment horizon is quite a ways out, and I'm not concerned about this short-term dip. So let me know down in the comments section what you think of the potential upcoming inflationary risk. What adjustments to your portfolio are you making to try to fend off the market downturn or potential risk to bond returns? Or is this all overblown and we're not going to see any kind of inflation as we haven't seen it despite the amount of money printing that we've done recently? Again, if you want to use any of these platforms, there are links in the description for most of them that get you free stuff when you sign up with them. Make sure you like and subscribe so you don't miss out on any of my future videos. Of course, none of this is financial advice. This is all for entertainment purposes. And let's get to today's jelly. Today's jelly is Control Ultimate Edition. Control is actually a video game that's been on Xbox Game Pass. I'm not really a big gamer as I don't have a ton of time to do it, but when I do have time, I enjoy playing a little bit. This is a game that I've gotten almost all the way through, including the expansions. It's kind of an action thriller type game, so if you're interested in a game like that, especially if you have Game Pass, it's worth playing, as it is free to play there. So here's a little bit of that trailer.
Gonna be weirder than usual. Can't be helped. They thought I'd never find this place. That I'd forget about him. They were wrong.
As you can tell, the gameplay is pretty unique, and it's definitely not a game to play with the lights off, unless you're feeling brave, but I kind of enjoy that. It's got a good storyline and a lot of action that's pretty fun to play. Comment down below if you like this game, or if you're at least interested in playing it. Again, like and subscribe before you go, and have a great day.